As we have mentioned in the intro to technicals, a candlestick formation is established by defining the opening, high, low and closing price of the specific time frame the candlestick refers to. If the opening price is above the closing price, then a candlestick with a colored body of prices is drawn. Usually, red color is used for coloring the candle. If the closing price is above the opening price, then a hollow candlestick, normally displayed in white with black border or a full green color, is drawn. The thick part of the candlestick is named the body or real body, which can be long, normal or short in proportion to the line above or below it. The lines, long or short, above and below the body or real body represent the high or low price range, and these lines are known as shadows, tails or wicks. For the particular day, the highest price is declared by the top of the upper shadow, and the lowest price is marked by the bottom of the lower tail. Please note that the body may or may not have shadows, tails or wicks. Moving now to the Doji candlesticks. A Doji candlestick is characterized by the fact that practically the opening and closing prices are equal. The length of the tails, whether up and down, could vary. A Doji candlestick has a uniqueness exactly in the sense that the opening and closing prices are on the same level. Dragonfly Doji. A Dragonfly Doji is formed when the opening and the closing prices are equal and at the highest of the day. If it has a longer lower shadow, it signals more bullish trend. When it appears at market bottom, it is considered as a reversal signal. And we move on to the Gravestone Doji. A Gravestone Doji is characterized by opening and closing prices being equal and all at the same time being on the bottom of the candlestick, allowing for a shadow to exist only above them. Should the shadow be a longer upper one, it is considered to signal a more bearish trend. When it appears at market top, it is considered as a reversal signal. We move now to the long leg doji. A long leg doji is characterized by the opening and closing prices being equal, yet also to have very long upper and lower shadows. Should the formation appear at the market top, it's considered to be signaling a market reversal. We move now to the hanging man. The hanging man is a bullish or a bearish candlestick that is characterized by a narrow body near the top with a little, if any, upper shadow and a longer lower shadow. The lower shadow is required to be 2 or 3 times the length of the body. It is considered as a bearish pattern during an uptrend. Moving now to the hammer. The hammer consists of a bearish or a bullish candlestick that is characterized by a narrow body at the top with a little or no upper shadow and a long lower tail. It is considered as a bullish pattern during a downtrend. And then we have the inverted black hammer. An inverted black hammer is a bearish candlestick which is at the bottom of the formation and has a long upper shadow with little, if any, lower shadow and resembles an upside down hammer position. It is considered as a bottom reversal signal that needs confirmation on the next trading day. Inverted hammer. An inverted hammer is practically a bearish or bullish candlestick representing an inverted hammer formation with a narrow body on the low side and a long upper shadow which is expected to be 2 or even 3 times the length of the main body and a small, if any, lower shadow. The formation is viewed as a bottom reversal sign, yet that could need to be reaffirmed in the next candlesticks. Hence, could be considered as a bullish reversal pattern. As mentioned before, the inverted hammer looks like a reversed version of the hammer candlestick formation. Like the hammer candlestick, the inverted hammer consists of 1 candle and when found in downtrend is considered a potential reversal pattern. It should be noted that the long upper shadow of the candlestick formation acts as an indication that buyers push prices up at the same point during the period in which the candle was formed, yet the intense selling pressure drove prices back down for the period to close near where they opened. As this occurred in an uptrend, the selling pressure is seen as a potential reversal sign. When encountering this pattern, traders will look for a lower open on the next period before considering the pattern valid and potentially including it in their trading strategy. Then we have the long lower shadow. A bearish or a bullish candlestick is formed with a lower tail that has a length of 2/3 or more of the total range of the candlestick. Normally it is considered as a bullish signal when it appears around price support levels. And then we have the long upper shadow, a bearish or bullish candlestick with an upper shadow that has a length of 2/3 or more of the total range of the candlestick. Normally it is considered as a bearish signal when it appears around price resistance level. Then we have Marubozu. A Marubozu formation is practically a long or normal candlestick, bearish or bullish, with no shadow. The opening and closing prices consist the high and low of the candlestick, not allowing for any deviation. A Marubozu formation is considered as a continuation pattern. Bibliography refers to Marubozu as the name of Japanese candlesticks formation used in technical analysis to indicate a trading instrument has traded strongly in one direction throughout the session and closed at its high or low price of the day. Practically, a Marubozu candle consists of only a body, and a bullish Marubozu candlestick indicates that the buyers were in control of the price action throughout the trading period that the candlestick represents and is considered as very bullish. On the flip side, a bearish Marubozu candlestick indicates the sellers were in charge and is considered very bearish. Then we have the shooting star. A shooting star is a bearish or bullish candlestick that consists of a long upper shadow and a little or no lower tail. It is viewed as a bearish formation in an uptrend, hence is considered as a bearish reversal formation. The shooting star looks very similar to an inverted hammer formation, yet is not to be found in downtrend like the inverted hammer, but in an uptrend, and thus implies a different outcome. The long upper shadow of the candlestick formation implies that buyers pushed prices higher at a relevant point in the trading period the candlestick represents, yet sellers were able to reverse the buying pressure, driving the closing price nearer to the opening price. Given that this happened in an uptrend, it can be perceived that buyers found enough resistance that may ultimately reverse the uptrend. Hence, traders expect a lower opening in the next period in order to reaffirm the pattern's bearish validity. Then we have the spinning top. A spinning top can be a bearish or a bullish candlestick which has a relatively small body while the size of the shadows may differ. The formation is considered as a neutral pattern, yet tends to gain more on importance alongside other formations. Then we have the three white soldiers. The three white soldiers is a candlestick chart pattern which represents 3 trading sessions and implies a strong price reversal from a bear market to a bull market. The pattern is formed practically from 3 long full-bodied bullish candlesticks which show an upward trend like a staircase. Each should open above the previous day's open, ideally in the middle price range of that previous day. Each candlestick should also close continuously upward to establish a new near-term high. As mentioned, the 3 white soldiers formation helped to reaffirm that the bear market has come to pass and market sentiment has turned bullish. This candlestick pattern has an opposite known as the 3 black crows, which shares the same attributes in reverse, and we are examining it next. 3 black crows. The 3 black crows formation is a chart pattern that is considered to be a bearish formation and is used to indicate the downturn reversal or formation. It develops across 3 trading sessions and consists of 3 long bearish candlesticks that trend downward like a staircase. Each candle should open below the previous day's open, ideally in the middle price range of that previous day. Each candlestick should also close continuously downward to establish a new near-term low. The pattern indicates a strong price reversal from a bull market to a bear market. The 3 black crows help to confirm that the bull market has ended and market sentiment has turned negative. In the bibliography, the formation is considered more useful for longer term strategies. And then we have the morning star. The morning star is a pattern formed by 3 candles. normally a long bearish candlestick followed by a short bullish or bearish doji, which is then followed by a long bullish candle. In order to have a valid morning star formation, most traders will look for the top of the third candle to be at least halfway up the body of the first candle in the pattern. Black candles indicate falling prices and white candles indicate rising prices. When found in downturn, this pattern can be an indication that a reversal in the price trend is going to take place. What the pattern represents from a supply and demand point of view is a lot of selling in the period which forms the first black candle. Then a period of lower trading but with a reduced range, which indicates an indecision in the market. This forms the second candle. Then we have the third candlestick that shows that buyers have taken control over the trading instrument's direction. Given that the morning star is a 3-candle formation, traders may not wait for confirmation from a 4th candle to confirm the change of trend. High volumes on the 3rd trading day confirm the formation. Hence, the size of the candles becomes an indication of the possible size of the trend reversal. Especially the higher the bullish candle moves in relation to the bearish, the first candlestick, the larger the potential reversal.